This is Declarations.
A lot of people talk about family capital's benefit is that it's long-term. And I think what we learned over the years is the ultimate attribute, the attractiveness of family capital isn't that it's long-term in nature. It's that it's flexible capital.
Hi, this is Todd Rich, and welcome to the Declarations podcast. The purpose of this podcast is to engage with thought leaders in investing who provide an independent perspective. Our goals are to explore the foundations behind their success, to understand the source of their inspiration, and through these conversations, to become better investors. We hope you enjoy this episode. Today, I'm joined by Paul Carbone, co-founder and president of Pritzker Alternative Strategies, as well as co-founder and vice chairman of Pritzker Private Capital. Over his career, Paul has led investment platforms at Robert W. Baird & Company, Kidder Peabody, and most recently helped shape PPC's unique long-duration family capital model. He earned his MBA from Harvard Business School and attended the College of the University of Chicago, where he continues to give back as a member of the Board of Trustees, both for the university as well as for the University of Chicago Medical Center. Paul helped to co-found the Chicago Booth Family Office Initiative, where he chairs the steering committee. Paul also serves on the boards of the Art Institute of Chicago and Misericordia Home, as well as the boards of two other family offices. In many ways, Paul is regarded as a dean of the family capital space, where he is a thoughtful ambassador for family office investors and is one of the voices helping to define what makes this community unique. Welcome, Paul.
Todd, great to be here. Thank you very much.
Well, I'm really glad you're here today. I always like catching up with you. And as you know, I start these conversations all in the same way. So, Paul, what is your declaration?
Yeah, well, it's an interesting question, and I've thought about it. And it really revolves around sort of an important aspect of my personal life, not my business life. But our first child was born with special needs. She can't walk, she can't talk. Her intellectual capacity is limited. And having her in our lives has been significant because it's taught my wife, Amy, and I, that there are a lot of people in this world who can't take care of themselves, that need help. And once we had Kelsey, Amy had to change her life. I changed my life, but Amy changed her life more. But we wanted to have more kids. We weren't sure whether it was our genetics that caused the challenge with Kelsey. And so we decided to adopt two kids because we decided that there were plenty of kids who needed parents, who needed a home, and we could afford to do that. So we adopted a child from China and a child from Wyoming, our cowboy. And it changed the whole trajectory about how we think about the world, how you think about what you need to do in this world to take care of other people for the rest of their lives. Kelsey will need care the rest of her life. But we've learned a lot from her about needs, joy, engagement, fulfillment, how to help and take care of other people who can't necessarily help and take care of themselves. So it's sort of set the trajectory of our lives. And it was hard, early years, very hard, especially with Amy being at home most of the time. She stepped off the career ladder as a corporate attorney, but it's been massively fulfilling and it's been helpful to set the tone in the approach. Amy's probably the most generous person I know. I think in part because Kelsey's in our life and she knows that we can help and there are a lot of people who need help in this world. So that's my declaration. I don't know if it's a good one or not, but that's it.
Oh, it's beautiful. And I've known about your daughter and I know how generous you have been and continue to be in so much of what you do. I had expected much of this conversation to revolve around family offices. What I had thought was that would be about investing on behalf of families. You're talking about something so much more important, which is how what you've learned and experienced within your own family has changed the course of your life, not just your career. And I think that's a beautiful sentiment.
Oh, well, thank you. Well, I'm also happy to talk about investing because I enjoy that too. But whatever you'd like.
Well, I'm sure we'll get to that. Let's start at the beginning, though. Let's go back to your own family. When you grew up, if I remember, I think you actually grew up in my hometown of Washington, D.C. as one of, was it 7 kids before you moved out to the Midwest? And everyone in your family was in healthcare, if I remember, or maybe doctors. How did that experience your worldview? And were they all very disappointed when you chose not to become a doctor yourself?
Yeah, the word black sheep came up a couple of times. My dad was a cancer doctor, and he worked at NCI and NIH in DC. So I was born in Bethesda, big Italian Catholic family. I have 6 brothers and sisters. 2 have since passed away, but we started with a family of 7. And as you know, if you're a doctor working for the government, you don't make a lot. So here he had 7 kids. It was interesting to grow up in that sort of environment. I was born in Bethesda. We moved to Silver Spring, and we moved out to the country. My dad bought a little land out in Maryland. And we grew up sort of as a group of 7, sort of exploring the world. Not all of them are doctors. I'm the middle, so it's 3 above, 3 below. The older 3 all became MDs. And I was the first one not to be. My father was totally good with that. And we can talk more about that later. But the next 3, IT specialist, a lawyer, and an MD PE guy.
So you broke the mold, but one guy at the end had to come back.
Well, the last one is MBA.
Oh, MBA. I'm sorry. I thought you said.
Yes. No, there's no more doctors after me.
No more doctors.
Mold and threw it away. But it was not an issue with my father at all. He had no clue, no understanding of what I did and what I was interested in. He had no sense of business, but he trusted that this was right for me, and he let me pursue my passions.
You seem to have had some level of interest in business or finance from a very early age. If I remember, you went to University of Chicago as an undergrad. Was it really because you had heard of Milton Friedman, the economist, and that was what you wanted to study? What was the appeal of that at such a young age, especially from a family of physicians?
Yeah, it's kind of geeky, but when I was young, I loved reading the stock pages, and there was a stockbroker firm near us, and I would go and watch the tape and read about companies. And my dad, knew that I was interested, so he bought me some shares in Disney when I was very young. And then
that was also my first stock holding.
Was it Disney?
It was.
Yeah. And so I've loved it. And so he fed that passion, and it moved. It wasn't just investing. It was also economics. And I read a lot of, we can talk later about sort of how I got on this path, but Milton Friedman became sort of somebody I was very interested in reading his materials. And I knew he studied and taught at the University of Chicago. And by then, Dad had moved the family up, but he took over running a cancer center in Madison. So I spent a couple years in Madison, and I knew I was even closer to the University of Chicago. And Milton Friedman in the economic department there was top drawer. And I said, I want to go there. And my older brothers and sisters all went to Amherst and East Coast, Harvard. But I wanted to go to the University of Chicago to study with Milton Friedman. Unfortunately, when I got there, the next year he left to go to Stanford and Hoover Institute. But the department was
it personal?
Yeah. He saw me coming, and he said, "Listen, I can't compete. There can't be 2 of us." So
right.
But he left. But it was a terrific training and undergrad experience.
Well, Milton Friedman may have been at the top of that food chain, but University of Chicago is well regarded for having a tremendous number of economists. I can't remember how many Nobel Prizes came out of that economics department.
100.
So it must have been a fascinating.
Well, 100 across campus of Nobels.
Wow, 100. That's incredible. And so after that, you unsurprisingly decided to continue in the world of finance, and you went into investment banking. I imagine you're not the only person to have graduated from that economics department to go into investment banking. You went to Kidder Peabody, if I recall, and then Baird. What did those work experiences teach you about finance and capital markets, and how did that differ perhaps from what you learned in an academic setting?
I'll tell you a little sort of story. During college, I knew I wanted to go into investment banking, so I had to choose between investment banking and consulting. And I was always numbers oriented and transactionally oriented. So I decided I wanted to go the investment banking route. And I wanted to learn the skills of dissecting a balance sheet, an income statement, the skills of valuation, deal making. And I wanted to see as much as I could to work down the learning curve, as many industries, as many companies. So I was ready to get going even during college. So I sent letters to a bunch of investment banks in New York, with the mecca, I thought, of investment banking. And the only job I could get was Kidder Peabody in the mailroom. I went and said, hit the bit for a summer during college, delivered mail, actually in the research department, and convinced them that I knew a little bit about computers.
This is the sell-side equity research.
Equity research, right.
And by the way, that's where I got my start. It was a summer internship, but same thing.
Which firm?
That was at Goldman Sachs.
Well, I
didn't have a mailroom at that time. I'm a little younger, I guess.
Step down. But Kidder was a great old partnership. delivered mail. Then I convinced them I knew a little bit about computers. And then I talked to the equity research analysts in the retail sector and said, I can write you a program that allow you to do your work easier and quicker, and therefore get to the market with your commentary. And I wrote a program. Then I found out research was a little dull. So I said, how about I can work over in that corporate finance department? And so I progressed from there. So I owe a big debt of gratitude to Kidder and all those people. But I decided that was the path. My senior, I could have graduated U of C early, and so I decided the senior year of college to try the PhD program in economics, to try to see if I get a master's or PhD in economics. And that took about 2 months to decide that I should go up the MBA route and go into business full time with investment banking, because it's just a difficult program.
So what was the appeal of going the academic PhD route? And then why ultimately I can't imagine you deciding to quit that for business because you thought it was too hard. That doesn't seem like you. What was the reason?
Theoretical. I thought getting steeped in the theory of economics would help create a foundation for making better decisions in the business. I always knew I wanted to buy and build companies, but I thought getting steeped in the theory would help me. And what I learned is their feet don't touch the ground. The theory is so out there and so mathematical that it wasn't going to be as applicable in the real world as I wanted. So I made the decision to go the investment banking route and to learn the skills of being an investor and a deal doer. I mean, that served me well, working with some great talent, doing lots of things, lots of different industries, lots of different companies. So it was terrific sort of setting to be a principal investor later in my career.
Yeah, so you were in banking for quite a while, but I think it was actually while you were a banker, perhaps at Baird, was it, that you then actually transitioned to principal investing? Was it using the bank's balance sheet primarily? Maybe walk us through why you found that interesting and how you approached it.
Yeah, and I did M&A at Kidder. Kidder was headed the wrong direction, so several of us decided, we needed to make a move. My long-standing mentor, Paul Purcell, and Steve Booth and I, we had the two options when we decided we had to leave Kidder. One was to set up the Dillon Reed Chicago office, or go to the small investment bank, which was really just a regional brokerage firm called Baird. It's about $170 million in revenues at the time. And we decided, let's go do something entrepreneurial and build this firm up. And Paul was slated to become the CEO over time. I was slated to build an M&A department, and that was the trade to get into principal investing, and Steve was going to run investment banking. And so we made the move, and I helped them build up an M&A department, and at nights, I would help them build out their investing program. And so they had 2 or 3 people doing opportunistic investing off the balance sheet. And we basically I eventually in 99 moved over full-time to principal investing. We built up an effort. We founded a venture firm. We moved into Europe. We opened an office in China. So we had lower middle market venture growth and buyout, US, Europe, and Asia by the time.
And was this just traditional merchant banking with the bank's balance sheet, or was this also you ended up raising outside capital as well? And
this was my first taste of raising outside capital. So we just started with the balance sheet. I think we started with $30 million, and then we built from there and raised third-party capital for the venture funds, the US buyout funds, the European buyout funds, and the growth equity in China. So it was my first taste of sort of raising capital on a multi-fund platform. It was difficult. You're within a regulated industry that's more an advisor and not a principal investor. And so it was a bit constraining. And I always looked over across the other side of the playing field and saw family capital, which had the luxury and the flexibility to do lots of different things, and often didn't require you raising third-party capital. So I was always intrigued with family capital.
Before we get to family capital, you actually, or maybe to set this up, I'm surprised actually many people who are in merchant banking, sort of a private equity role within an investment bank, they like the buy side. I've heard others mention the constraints, particularly sort of post Sarbanes-Oxley. This sounds like it may have been earlier than that. And they say that they look to the other side of the table and they think about joining a straight private equity shop. You sort of had a different view, and you said, no, I don't want to join an established private equity shop. I like family capital because it's somehow different. So maybe if you could explain for us what you saw as the differences and what you saw about the appeal of family capital specifically.
Yeah. Listen, the traditional PE is a massively successful business model, but I got exposed to some Chicago families and saw and worked with them on their investing and their M&A activities and saw how they could make decisions.
And by the way, for those who don't know, Chicago has one of the strongest networks of family offices in the country with really, really sophisticated and long-term owners of businesses, real business builders and investors. But sorry, keep going.
So after New York stints, they basically sent me back to Chicago, and I stayed here basically the rest of my career. And it's been a terrific place to build a career. But I saw the flexibility they had. They didn't have to go raise third-party capital. They could invest with flexibility. They can invest with different purposes, agendas. They could build companies differently. It was pretty clear. Now, sometimes they didn't do that with the discipline or structure or sophistication that maybe you would want, but you could see the opportunity to do something fundamentally different and build fundamentally different companies using that kind of capital. So I was intrigued. So when I got the call from Pritzker, it was difficult because I was leaving my mentor who I'd worked with for 28 years. We'd helped build up Baird. We bought Baird back from Northwestern Mutual. The employees owned it. We were building a private equity business. But the Pritzkers had a real proposition. I said no twice.
How did you first get to meet the Pritzkers? What happened?
Well, they saw Baird show up on a list of top 10 lower middle market firms or something like that. And we both had a common friend. And they said, you really need to talk to Paul. And so we engaged. They had a great career going, but they had a great proposition. And the proposition is a great brand that I thought was underutilized, under-maximized. They had a significant pool of liquid capital because they had just finished the transition from second to third generation. So they were significantly liquid. They had been in the lower middle market buyout business, but in a more limited way before I got there. They had the intent of building a world-class capability. They were returns-focused, not trophy asset-focused. They were fact-based, not sort of whimsical, and sometimes you see in some families. And most importantly to me, in addition to the fact that they had advantage capital, and we can talk about why I think family capital is advantaged, they had a value system that I thought was attractive.
What do you mean by a value system?
The Pritzker's value system, honesty, integrity, loyalty, are the core elements of the value system that they operate through, they live their lives by. And then the other sort of secondary sort of values that are also sort of attached to that are, let's treat people with respect, but excellence is the objective. And so it's that sort of culture, that sort of philosophy is one of the elements of creating advantage for family capitals. That philosophy is imbued in their capital.
No, those are obviously wonderful virtues, right? To talk about integrity, honesty, hard work, people that you like and that are kind, focusing on excellence, returns, facts. All of those are almost inarguable. Do you feel that somehow that is easier to find in the family office space than in a traditional private equity or private equity associated with an investment bank model?
Listen, I don't want to denigrate traditional PE. I'm an investor in traditional PE today for a family. But I fundamentally believe that family capital is inherently imbued with the philosophy and the value system of the families. It's inextricable. And that's different than traditional institutional capital. It's OPM, first of all. It's other people's money. And you can have a culture within traditional PE, but the capital itself is not imbued with the family's philosophy. It's more sterile. It's got very specific mission, and that's returns. Now, families have return objectives too, but how they accomplish their return objectives, the duration of that, how they make decisions, it's reflective of who they are, and who they are is what is really the values and philosophies they bring.
Sponsorship is really key. It's critical, it sounds like.
Totally.
Yeah. And now you just called family office capital advantaged capital. So maybe you'll touch on this, but what are some of the advantages that you see as family office capital besides maybe just the sponsorship if it turns out that the family's values particularly well regarded, which is what you explained about the Pritzkers?
And I've talked about this in multiple settings. maybe it's worth repeating.
In fact, I think that you're the best at it in our whole little cottage industry of family offices.
You are so kind, Todd. You are so kind. But it's the concert of a few things. One is the capital is inherently permanent and proprietary. It's their capital, and it doesn't have to be given back in any specific time frame. And the fact that it's imbued with the family's philosophy and cultures. Those things together give the capital characteristics, allows the capital to do different things, the flexibility to do different things. And then it appeals to certain users of capital, sellers, in a fundamentally different way. And if you can take that concert of characteristics and the attractiveness of the capital to certain users of capital, and the fact that they view it as advantage, the users of capital, you can create competitive advantage in a commoditized world. And I fundamentally believe that, and I've seen it in practice as we built up PPC.
By the way, you're preaching to the choir. I agree entirely. I actually think there's one other advantage that I have heard you express before that I'll tee up for you almost as a softball.
Sure.
But the other thing that I've heard you express, which I agree with, is that family capital, when commingled and aligned with one another, then creates a network effect where the families involved can learn from one another and can share their experiences in order to help, whether it's, I don't know, calling a customer or finding a new, talented manager of a company or, working on the board of directors. There's this network effect that when families working together can come together that offers additional advantages on the deal sourcing or on the execution side that I think is so fascinating.
Yeah. There are very few markets like the family capital network. The inherent willingness to collaborate, to communicate, to share ideas. It's, unique is a very strong word, but I have not found a market like family capital anywhere else. Traditional PE firms don't collaborate. Families love to talk to families. They're open, often, not always, and I'm painting with a big broad brush, but often very open, sharing ideas, helping each other. They love to collaborate. And that's not found in many markets.
It's unlike anything I've ever experienced before. Someone else, I think on this podcast, described family office capital as a round table where we're all working together, we're at equal footings, but the practitioners, whether it's the professionals or the family principals or other investors in the network, all try and help. And the help can come in a variety of forms. So I think it's really a fascinating experience. I'm thrilled to have been part of it. And I know you're a real leader in the space. Hi, this is Todd Rich. Thank you for listening to the Declarations podcast, where top investors and business leaders share their insights and provide an independent perspective. We hope you're enjoying this episode. If you'd like to learn more about Declaration Partners or listen to more episodes of the Declarations podcast, please visit our website at www.declarationpartners.com. And now back to the episode. When you did this, you created Pritzker Private Capital with the Pritzker family. So maybe just for those who are not as familiar, and I imagine everyone in Chicago at minimum is familiar, but can you just give us a sense as to who are the Pritzkers? How did they create their wealth? What are they trying to achieve? And then maybe we'll talk about PPC specifically.
Yeah. And again, just to be crystal clear, very few people do things alone in this world. I helped with a lot of really talented colleagues, and with the family, we built something I think that's pretty special. So I just happened to be part of the team. But the Pritzker family is a fabulous family, 90 plus year history of buying and building companies, a massively philanthropic family. The families used to be headquartered sort of in Chicago, but now the family's scattered around the country and world. The family's best known, its most consumer-oriented brand is the Hyatt business, Hyatt Hotels. So they didn't found it, but they bought a motel on the West Coast near an airport. And the Pritzkers had the philosophy this is just as sort of airline travel was taking off, is that people are going to need places to stay near the airports. And they bought from the Hyatt brothers a motel, effectively a motel. And Don Pritzker, J.B. Tony and Penny's father, built up Hyatt early. Now, Don passed away young, but he was really the person who took one single unit and built it up into something very significant. The Pritzkers also have real estate, lots of other businesses. that they built up over the years. And they operated together through G2. It's when G3 happened that they sold the jointly held assets and distributed down to the 11 third-generation family members.
And then Pritzker Private Capital was founded really with, if I recall, that was Tony's the family originally. Is that correct?
I joined Pritzker Group, which was the investment business for Tony and JB, the brothers. And we built up PPC1 with just the brothers' capital. The initial deployment was just the brothers' capital, where we're still within the family investment group. JB went off to do his public service work on 16, 17. So from then,
for those who don't know, JB Pritzker is now the current governor of the state of Illinois.
Correct. And Tony really built a business after that. And we took the middle market business that we had built up within the family investment group, pulled it out of the family office, and built that business up alongside the family investment group. And we did that in part because we thought we could scale the business, build the business, accomplish the family objectives more effectively. And in particular, we did that so we could register that entity and bring in other families. We had a lot of families knocking on our door, wanted to partner with us, and this was the best vehicle to do that. That's really when PPC was born, when we pulled it out of the family investment group.
Got it. And PPC, you then helped grow the firm, grow PPC pretty meaningfully over the next, it must have been a little bit more than a decade now. PPC is generally very well regarded for its long duration capital, which you alluded to, right? So maybe just to talk it through, what do you think you guys got right about that model?
Yeah, the brothers always wanted to build a top tier franchise. And to have a top tier franchise with top tier returns, you needed a top tier team. And I think the brothers understood that we needed to attract and retain and develop a top tier team in order to accomplish the objectives. And that's one of the reasons why we took third party capital. It gave us a bigger base. We could pay and incentivize people appropriately. We could diversify the LP source of capital, and we could build a human capital business, which happened to deploy financial capital. I mean, this is something I've learned over the years. This is a human capital business in its essence.
I want to acknowledge for listeners that we at Declaration have fundamentally adopted many of those principles really as I won't call it explicit homage to you and to what the Pritzkers have built at PPC, but I would certainly say it rhymes. And we really think that you've done a lot of things right, and we're trying to aspirationally do similar things.
Well, you're very kind to say that because I think you've gotten a lot of things right. I think you guys are building a fabulous business, just to return the favor. It's very impressive.
Time to say, I guess we should do more things together.
Game on. A lot of people talk about family capital's benefit is that it's long-term. And I think what we learned over the years is the ultimate attribute, the attractiveness of family capital isn't that it's long-term in nature. It's that it's flexible capital. It's not jammed into a business model that requires you to do X, Y, and Z by ABC year or timeline. That the capital allows you to make the right decisions at the right time for the right reasons for the right duration. And what we learned over time was, even though we buy businesses that we thought we'd own forever, the reality is it was less than half. That it really made sense to hold on for an extended period of time. The world moves too fast. It's too competitive. The dynamics change. The competitive dynamics change. The technology changes. But what the capital allowed us to do is make the right decisions. And what we talked in terms of biases, we had, based upon what we saw as the return opportunity for the risk profile we were taking, we were biased. If we saw the risk profile changing and the return dynamic changing, we might be biased shorter. If we saw triple moats around a company and that the return profile for the given risk exposure could continue, we'd be biased long. But the capital allowed us to do that, and we weren't constrained by the business model of traditional PE.
So what I'm hearing when you say long duration capital, that doesn't mean, like Warren Buffett, that you won't sell or very infrequently sell. What it really means, if I'm hearing properly, is that you are unconstrained by artificial pressures to sell, and that you'll make what you think is the right decision based on the risk assessment. Is that accurate?
Totally right, because there are real good reasons to sell businesses. You've done everything you can with the business. The opportunity for the risk has changed. There are reasons I can redeploy the capital and higher returning opportunities, but you just don't want to be forced to sell. I remember when I was running traditional PE, and again, no offense to my traditional PE colleagues, I would sell my winners first. And so we were harvesting the best and keeping the less attractive. The other corollary here, which is a little bit of a pet peeve, and some people may have heard me say this, but it relates to the long term. But people say, oh, family capital is patient capital. Maybe some family capital is patient capital. Our capital was not patient. Because we get investment bankers say, oh, you're going to get 400 basis points over treasuries. You're patient capital. That's good return. And I would say it's a function of the risk, not the return. And so we make our capital sweat every day. We make the decisions if we decide we want not to take a return or not take dividends or not grow the business for a certain period of time because we're investing. But we want our capital to sweat every day because I'm taking risk every day. And we need an appropriate amount of return to compensate us for that risk. So I just find patient capital to be the wrong word.
There are certainly, and I'm sure you've gotten this too, from sellers or brokers, intermediaries, who think that because we are associated with family capital, we should therefore almost automatically be willing to take very low returns for very long periods of time. And that never sat well with me. It sounds like it doesn't with you either.
It's kind of a silly concept. I mean, families are silly and stupid. They're willing to take an inappropriate amount of return for the risk they're taking. I mean, it's kind of insulting if you.
Well, you're clearly an investor at heart. What has been the hardest part of trying to balance, this, as you called it, advantaged family capital, but investing in pretty competitive markets where you are competing with other, whether traditional private equity firms, it could be with strategics. How do you balance that? What have been some of the challenges you've had to face?
Yeah, just because we have advantaged capital doesn't mean we don't have to compete and win and have a right to win. So we focused our capital on sellers and users of capital who are biased towards us, who are inclined towards our kind of capital because of what we could do together. But that doesn't mean that you can underpay for businesses. It doesn't mean you don't have to have industry expertise. It doesn't mean that you don't have to have a compelling value proposition and value creation plan for the company. So you have to still have deep sector expertise, operating capabilities, an understanding of working with partners and colleagues and building companies in the right way for the right duration. So the advantage capital is necessary, but not sufficient in competing in a competitive world. And what we did is coupled with a couple of deep sector expertise, operational intensity, and a great team that could go out and win, and couple that with advantage capital. And together it made for a very powerful value proposition in the market.
Yeah, in some ways, it sounds like you're trying to take the best parts of what a traditional private equity firm may have, right? Which is all those elements about the strength of team and the decision-making process that's institutional in a sense, but then combine that with the flexibility or the advantages of family capital.
Totally correct.
It sounds like a pretty compelling model, but after doing it for a number of years, you've now decided enough. You recently stepped down as managing partner of PPC. I guess you're still involved.
Not involved day to day.
But you are the vice chairman. So I'm curious what that means and what led to your decision and what's it like? What does it mean?
I'm a believer that the CEO's number one job is to ensure the sustainability of the organization and the achievement of the objectives of the organization. And I think there are a lot of organizations, and too often it happens in PE, where succession planning isn't done well, that there isn't a defined plan. Ours was a multi-year plan. We had decided, worked on this with Tony and the team for an extended period of time, developing the next generation of leaders, making sure the organization is ready. Because what you want is at the time of succession, that people say, of course, that's what should happen. And so we were committed, Tony and I and the team, to make sure that the succession happened well and sustain the organization. For all of us, it's our legacy. I'm very proud of what we built, but I'm also a believer that, after 10 years or so, I've put my mark on the business. I've done what I wanted to do, but it's time for the next generation to take over and put their stamp on the business. So I'm also not one to be a former CEO who hangs around the hoop. I wanted to say, let's work on a plan, let's transition, And now the ball's yours. And I'm here to be helpful if you need, but the ball's yours. And you do what you think is right with the business for the next period. And you hand the ball to the next leaders.
What you're describing, the approach that you and Tony and maybe others have taken is like a family, right? You have chosen to educate and train the next generation to become their own adults and then to move on. Does that feel good? Is it harrowing? How are you responding to this change?
It's difficult, but it's the right thing because it was right for them too. We have great Michael and David and Brad. They were ready. And to not make this transition would create an issue for the organization. So they were ready. I think they're doing a terrific job with the business. So it was the right thing. And then it was the right thing for me too. I was looking, I think, in 10-year increments in my career. And I was looking at the next 10 years. And I'm not a go to the beach, play golf kind of guy. I wanted to do the next chapter. Tony and I still wanted to work together. And Tony and I created a plan to go execute on the strategy, as well as allows me to do my civic activities, my other boards.
So this next chapter is that you co-founded or helped co-found with Tony Pritzker Alternative Strategies. So it sounds to those who are uninitiated, it sounds, okay, Pritzker Private Capital, Pritzker Alternative Strategies. I'm not smart enough to understand the difference. So maybe you could please explain, what is the difference? What are you trying to do over the next decade plus?
Yeah. So at PPC is a direct invest business. It's buying middle market companies that fit the strategy and capability that PPC is looking for in the sectors where it has.
PPC raises capital, some obviously from the Pritzker family, and then invests in companies directly, buys those companies.
Helps build those companies.
Okay. Pritzker Alternative Strategies, in contrast.
Yeah. And so I was ready to step away from the coalface. Being a direct investor is a 24/7 business. You're living and breathing, you're investing in your companies. And I was ready to step away from that. I'm no spring chicken anymore. But I had over decades learned about the alternatives market, the opportunities to create value in the private markets, the very many aspects of the private equity market that were very attractive that PPC didn't address or serve. We had historically advised Tony really to limit his exposure beyond PPC, and he had significant exposure. But he made the decision as he looked at sort of his next gen and what he wanted to do with his life and the business, that he really wanted exposure to other aspects of private equity. But we were bound and determined not to do it on a direct basis. We wanted to do it on what the market calls a passive basis. So we said, let's invest in top tier managers. Let's focus on the lower middle market within private equity and a bunch of exciting sectors and strategies and geographies that complement his exposure to PPC.
You are now allocating funds then to other managers. Those other managers will be doing the direct work, but so you have to now pick those teams, pick those strategies. Is it just funds, or are you also doing co-investments, CVs, or the continuation vehicles are talked about frequently? What else are you working on?
Yes, we're investing, finding the managers who are at the coalface, and we're 2 steps behind them, providing the support. And that support can take the form of capital, but multiple forms of capital. So we'll invest as an LP in these funds, but we'll also support them in other ways. So these funds, this ecosystem throws off equity returning opportunities in multiple ways. And we want to capture all the alpha, all the equity returning opportunities that these funds generate. So we're an investor as an LP, but we'll also be a co-investor. We'll invest in CVs, secondary LP interests, seeding stakes, GP stakes. So we're trying to capture the whole ecosystem of equity returning products.
And I imagine that fundamentally there are similarities to direct investing, but you're really picking people in some ways and strategies. So maybe if you could just explain, how does investing in those managers or in their funds, how does that differ from direct acquisition, negotiation of companies?
Well, you hit on it. I think it's the people. So I helped build a GP. I know what it's like to sit in that chair, to build teams, to create incentives, develop people, create strategies, implement those strategies. So I sat in that chair, and now working with my colleagues here at Pritzker Alternative Strategy, who bring a more focused, disciplined LP expertise, we can combine both the GP and LP expertise as we work with and support these lower middle market, more emerging managers. And it comes down to decades of experience in this world, understanding the talent, the incentives, the culture, the winning strategy, the process and procedures and disciplines. It's seeing the whole package and understanding the probabilities of that whole package having a right to win in the marketplace on a sustained basis. And it's a bit of because you're investing in a blind pool, you're taking a risk. But there are thousands of managers out there, and all I need to do is pick the 20 best ones in the near term. And I think I can do that. And I have a leg up on it because of my history and the experience of my colleagues.
And now where, as you survey the landscape of, as you call it, the thousands of managers, where do you see the biggest opportunities in the alternative sector over the next, 5 years or 10 years, or however you want to define the opportunity set?
Well, first of all, let me just start within PE itself. You run across people today who say, I'm just going to stay with the S&P. Public markets, they're highly liquid. They outperform PE. And I'm just going to stay and invest in the S&P index. And I don't need the illiquidity and the risk of the private equity markets. I happen to think that's a very short-sighted way of looking at the world and the investment opportunities in the equity market. So one, I'm a big believer in private equity as an asset class in terms of talented people with the right incentives, with the right approach to go put their hands on the steering wheel with management to go make improvements in businesses and change the trajectory of the opportunity within businesses. So to me, that's a really great way to capture alpha in the equity markets. And over the long term, I continue to believe what we've seen in the last 25 years, which is private markets will outperform the public markets over the long term. And it's because of active, incentivized, talented management helping change trajectory of business. So as a set of opportunities, private equity, I think, is terrific. And there's multiple ways to play that. What we're seeing today, a significant portion of exits now are happening in the CV market. So there's an interesting play there. The secondary market and the disruption in fundraising, interesting play there. And I'm not saying that one is better than the other necessarily. I think both have a role in the portfolio. Both the liquidity issues, the risk profile, both have a role. What I object to, if somebody's saying, I'm going to stay out of the private equity markets for now because I can just get what I need out of the public equity markets. And candidly, when you think like a family, you've got to think long-term. Short-term thinking doesn't pay. It takes time to build a great portfolio. But over time, I'm telling Tony, we're going to build a great portfolio, and you still should have your public equity portfolio, but don't miss out on this opportunity.
Okay, so now some family listening to this has decided, okay, they will have, some public exposure. They want now to find private market exposure. They agree with you that families maybe have a different way of doing it, so perhaps should do it together. They want to find great teams and great opportunities. So Paul, open the playbook.
Yeah, well, listen, what we've decided is there's these other markets, right? Secondaries, CVs, et cetera. I think those will have continued meaningful opportunity. But what I can tell you, I've always thought playing a strategy, go deep, build expertise, be the leading player in your sort of space. And there are lots of other opportunities to play, but where we want to play is lower middle market, biased towards early vintage funds. Not exclusively. I think drawing hard lines in the private equity market is a mistake.
When you say early vintage, meaning a fund one, a fund two, a fund three.
Fund 1, 2, 3, lower middle market biases. We'll invest in fund fours because you're looking for the right characteristics, opportunities, rights to win. The primary focus is go back great managers, get diversification by sector, time, strategy, geography. And that's the combination that will be sustainable and winning over time.
Got it. Well, obviously, I wish you and your investors luck there. Let's step back a little.
Notice I didn't talk about real estate. And if they need real estate advice, they should go to you because we don't do real estate.
Very kind, very kind. Let's step back, though. You've taken a leadership role. Obviously, PPC and now what you're doing with Pritzker Alternative Strategies are two elements of what I would call, using your term, alternative family capital, which is to say family capital combined with other capital to focus on a different way of investing. If you could, and you've, by the way, been a leader in organizing some other family offices, what I would call peer family offices of yours who have chosen to apply this methodology and work to try and harvest the advantages of family capital. Can you talk a little bit more about how that trend is developing and what you think the broader impacts might be on the overall universe of investing?
In particular, sort of this alternative family
Yeah, an
capital.
alternative family capital, families working together in the manner that you built at Pritzker. But there are others doing it, right? The DeVos family is doing it. Obviously, we're doing it. The Eccles family is doing it. There are many others. I'm not trying to pick favorites.
Yeah. So we, in fact, I helped co-found the Alternative Family Capital Network precisely because of that, which is we saw more and more families trying to pursue their objectives, but also to function and deal with and compete in a highly competitive, diversified marketplace. And what they were doing was implementing various strategies, different than the traditional family office, but implementing different strategies to go figure out how to compete and win in the competitive marketplace. And they were taking alternative approaches. We brought in third-party capital. You're doing what you're doing, et cetera. And we said, let's gather those people to collaborate, to share challenges and risks and opportunities. And again, playing on this family concept of collaboration and communication, get those people together twice a year. And we formed this network, of which you're a member of this network. And that's what's interesting is we've seen that grow every year. So more and more families. When we first formed this network, I think there were 19 families as part of our network. We're now up, approaching 100 families. We're involved in our network. And there's many, many more. But it's part of sort of families being smart, that being dynamic in a competitive, changing marketplace, and being static is the risk. But you've got to change strategies, evolve strategies, migrate strategies to really compete and win in a changing marketplace.
So that's one group that you founded. You were also pretty helpful in founding the University of Chicago Booth Family Office Initiative. And I believe actually with the Pritzker family as well. And it is worth disclosing that Declaration's anchor investor, David Rubenstein, is the chairman of the University of Chicago and has been involved in this initiative, the Family Office Initiative. Maybe if you could talk a little bit about what you are trying to achieve with that group.
Yeah, what we're all trying to achieve, which is there's a lot of academic institutions that have done a fabulous job addressing family business and trying to bring sort of a disciplined research and education approach. But there are relatively few academic centers that have focused on family offices as distinct from family businesses. And we had discussions with Booth and the University of Chicago about the opportunity to build a premier family office-centric program sitting on top of a major academic institution. And they basically gave the challenge, which is to prove it to us, if that's such a great opportunity. So we hired 4 MBAs. We went out and did desktop research, interviewed a bunch of families, and the results were crystal clear. Families said, we don't get necessarily what we want in terms of family office education and networking in the way we want it. And so we formed a strategy around that research and got the dean's support and launched it. And basically, it's an initiative that's mission is its target is current and future leaders of family offices. And it's 3 missions: education, research, and network. And the network piece, let me start with that, is we formed a steering committee, then a family office council. Then we had our inaugural summit last year where we're gathering
I was thrilled to attend. I thought it was far better than expected.
Well, I appreciate that. Now there are challenges in our sophomore year just to make the next one even better. But
sure, you're up to it.
Yeah, thank you. So the key was gathering families who could share experiences and leaders in family office, mid-level people in family offices, to do it outside of a sponsored model. So there were no sponsors. There's no service providers. They wanted a setting where they could talk among themselves. So we formed an endowed model. So a network of families with an endowed model, no third-party service providers, sitting on a major academic institution where you could dip into the intellectual capital across the university. That's what we heard back from families. And that's what we're implementing. So we're launching MBA courses, executive ed courses. We've got research underway in the family office space. And we've got these various councils and summits to create and foster a dialogue and a network among the families, all focused on family office sort of challenges and opportunities.
I got to tell you, having attended The level of engagement and involvement, not just from the other families, but actually from the professors as well, was phenomenal. I now understand why you chose to go to the University of Chicago in pursuit of a single professor. I could have followed any of the professors we met with. It was really exciting.
It's a terrific school.
Let's talk more broadly in Chicago. And as you know, I used to live there as well. I love Chicago. So much of Chicago's business and culture influence is rooted in these positive philanthropic involvements from major families. Obviously, you're working with the Pritzkers. The Crown family has been incredibly generous. The MacArthur family, the Duchossois. There are several others that I failed to mention. What is it about Chicago, or maybe the Midwest more broadly, that has created such an enduring model of family legacies and such a positive contribution to the cities?
Yeah, and in fact, we see it spread across even corporate leaders too. It's been a culture and expectation that leaders in the community and these families and some select corporations set the example that there's a role for families to contribute to the city. So there's an ethos that there's a responsibility, that there's a role to be served, and that they can fulfill that role. And with a public and private sort of approach. And that's a civic responsibility. And it's really interesting that the families here are massively philanthropic, but it goes beyond that. It's contributing time and effort, serving on committees, and they set the example for the next generation. It's basically been passed down through the generations in the families where there are role models and expectations.
You've been deeply involved yourself in Chicago civic life. I know you've been on the board, maybe still are, on the Art Institute of the University of Chicago board. How do some of these commitments connect with your professional philosophy? How do they give back to you? What do you get from them? And why is it that you feel so connected?
Yeah, it's an interesting question. A couple of things. One is I had a mentor who gave me good advice when I was younger, who said, I don't care how hard you're working, Paul, and work really hard for your company. Save 10% for you, to develop you, to fulfill what you want to fulfill personally. And so I always, one, took that to heart. And two is, again, I had mentors and people who set examples for me about what was expected in terms of giving back. And I believe community service, civic involvement is really the perfect hat trick.
Okay. In what way?
It's good for the soul. It's good for you as a human being to contribute labor, your expertise, to help the community, help people. Second, it's good for the community. You can provide talents and expertise to advance the cause, whatever that cause is. And then third is it exposes you to a network of people you never would have met or been involved with, in my opinion, if you just kept your head down and pursued a career in business. And that could be and has been helpful to me in my business, my professional life. So it's good for the soul, it's good for the community, and it can be good for my professional career. Sounds pretty good to me, that concert of the three. And so I've always really enjoyed it. So I've served with the Lyric Opera, I've served on the Shed Board, the Chicago History Museum Board. And the other decision I made was I didn't want to just go to 4 quarterly dinners or lunches and have mediocre chicken, as they say. So I made the decision, if you get involved, be a leader in the organization. And I try to pick 3 at a time, and then have sort of complementarity, and then contribute, do what you can, add your efforts, and you put your mark on it, and then leave. So I try to rotate every 6 to 10 years where I'm involved.
Now let's talk about the last one, which is looping it back to your daughter. You started this discussion talking about how your daughter, who has special needs, has been such an important and positive influence on your life and the life of your family. But it opened up your mind and your wife's to the needs that other people who are perhaps less fortunate have. And so you've decided to make misericordia a really important part of your philanthropic giving, both time and capital. So maybe for those who are not as familiar with the Chicago landscape, what is misericordia? What are some of the reasons that you give back there, and how can others help?
Yeah, no, listen, I appreciate you asking that question. Misericordia is a longstanding institution that works with houses, takes care of people who can't take care of themselves. And it's not a small community, but it's a campus setting. So my daughter got involved in day programs and training programs But eventually, after she lived with us for 26, 7 years, she moved there. So it's a residential campus. And so her life is fulfilled. She's engaged with the world, with other residents, and the staff there are angels. They take care of these people who can't take care of themselves. And so it's a fabulous organization. So I've joined the board. I've been involved over many years with the group, and Amy and I contribute time and money to support a terrific institution. And it all goes back to helping people who can't help themselves for no fault of their own, by the way. They didn't ask to be born this way, but that many were born this way and they need help.
It's fantastic that you do that. Well, Paul, I have loved this conversation. It has come now to what I call our closing questions. So more rapid fire, but if you could just give us a book that really influenced your thinking or your own personal development.
It's kind of nerdy, but I'm going to say it's early on. I read a book by Hayek called Road to Serfdom. Road to Serfdom talked about sort of the dangers and hazards of controlled economies and the implication that that has in personal lives, political lives, liberty, all sorts of influence, but how controlled economies create issues in all sorts of different unintended ways. And that really led me to Milton Friedman and all sorts of other.
It sounds very Friedman-esque.
Very Friedman-esque. He wrote that book in, I think, the 40s. But that was a book I read early on and sort of helped me sort of find a path.
What is the best advice that you received from your parents or that you give to your own kids?
Yeah, it was really my father, who, again, was a physician, had no clue about interest in business. And he basically was very supportive. He could have said, you're going to be a doctor like the rest of them. But he basically said, pursue your passions, but understand that an education is the foundation to success in whatever you decide to do. And so we have PhDs and MDs and JDs and MBAs in our family because our parents sort of encouraged that getting an education, regardless of what we wanted to do, was the critical foundation. That's advice I think was really helpful to me, and I try to pass it along to my kids and young people I work with.
The Declaration of Independence often talks about the rights for life, liberty, and the pursuit of happiness. So, Paul, what do you do in pursuit of happiness?
Yeah, my answer here is not sort of highfalutin. I live the best life I can because I do many different things. I love having my fingers in lots of different pies. So my pursuit of happiness is my bird hunting. It's my civic involvement. It's my commercial involvement. It's my working with my family and doing some interesting things. It's working at Misericordia. I love having multiple challenges and opportunities across a wide spectrum. So I'm not one of the guys that says, I need to do this and this only. I would get bored. So
variety is the spice of life.
I kind of think I call it a portfolio of activities centered on the family and some key aspects, but I love bird hunting and traveling and reading and commerce. And I just like the variety of the stimulation that comes from that.
Well, this conversation has been stimulating, and it's clear that you have been incredibly influential in the world of family office investing in a variety of ways. I suspect that you will be for many years to come. Paul, thank you for sharing your time and your insights with us today. I couldn't thank you enough.
Todd, it's been a lot of fun. Thank you very much. Appreciate all your support.
This podcast is provided for discussion and informational purposes only, for use by Declaration Partners LP, together with its affiliates, referred to as Declaration. The information discussed in this podcast may change at any time without notice, and there is no duty by Declaration to update any person to whom this information is provided. This podcast does not constitute an offer to sell or the solicitation of an offer to purchase any investment product or any interest in the fund or any other investment vehicles or accounts managed or advised by Declaration, a Declaration investment product, in any jurisdiction to any person. Any such offer or solicitation for interest in any Declaration investment product will only be made pursuant to such Declaration investment products' definitive offering documents, which contain a description of the material terms, including risk factors, conflicts of interest, fees and charges, and regulatory and tax considerations relating to such declaration investment product, and which should be reviewed carefully by potential investors prior to making an investment decision. This podcast does not constitute tax or legal advice. The listener is urged to consult a professional tax and/or legal advisors regarding the possible tax, legal, economic, regulatory, or other risks and consequences associated with any investment, and must be able to bear the risks involved. This podcast may contain certain forward-looking statements, which constitute declarations' views with respect to future events, which can be identified by the use of forward-looking terminology, such as intend, seek, expect, target, project, or endeavor. These statements are made based upon such views as they exist as of the date herein. There is no assurance that such views are correct or will prove, with the passage of time, to be correct. Actual events or results may differ materially from those contemplated by such forward-looking statements as a result of factors beyond declarations' control, including, without limitation, any disruptions in global, regional, or local financial, credit, or real estate markets, acts of God, fire, hurricanes, tropical storms, floods, earthquakes, or other natural disasters, outbreaks of an infectious disease, pandemic, or any other serious public health concern, war, terrorism, labor strikes, electricity shortages, or other national or local emergencies, or any combination of the foregoing. David M. Rubenstein is an anchor investor in Declaration Partners Real Estate Fund 2 and is not an employee of Declaration. Neither the U.S. Securities and Exchange Commission nor the Securities Regulatory Authority of any state or other jurisdiction has passed upon the accuracy or adequacy of this podcast. No compensation has been awarded to any speaker for statements made that are either testimonials or endorsements. However, certain speakers may be current or former investors in certain Declaration investment products and may receive reduced fees, priority terms, priority access, co-investment rates, among other preferential treatment, which may pose a conflict of interest. Certain speakers may also be affiliates and/or service providers that receive compensation from Declaration for services provided in their service provider capacity, but have not been compensated specifically for any testimonials or endorsements made herein. The views expressed in this podcast by either the guest speaker or the host are their own and may not reflect the views of their firm or its affiliates or of Declaration. The comments made are for informational and educational purposes only and should not be considered investment, legal, or tax advice, nor a recommendation or offer to buy or sell any security or investment product. Any references to advisory services, private investments, or wealth management practices are general in nature and not indicative of future results. Past performance is not indicative of future outcomes. Examples and observations shared by the guest speaker are illustrative only and may not reflect actual client experiences. Listeners should consult their own professional advisors regarding their individual circumstances. The guest speaker may have professional relationships that could present potential conflicts of interest related to statements made by the speaker. Consequently, from the foregoing, no reliance whatsoever should be placed on this podcast, and no decision, including any investment decision, should be made based on this podcast or on the information contained herein.